Hello and welcome to Money Maximized. Today, we are going to talk about expense-to-income ratio. The expense-to-income ratio, also known as the efficiency ratio or operating expense ratio, is a financial metric used to assess the efficiency of a company's operations by measuring the proportion of its operating expenses relative to its total income or revenue. It is often expressed as a percentage or a decimal. The formula for calculating the expense-to-income ratio is as follows. Here's a breakdown of the key components. Operating expenses. These are the costs incurred by a company in its day-to-day operations. Operating expenses typically include items such as employee salaries, rent, utilities, marketing expenses, administrative costs, and any other expenses directly related to running the business. Total income or revenue. This represents the total revenue generated by the company from its core business activities. It includes sales revenue, fees, or any other sources of income that contribute to the company's top line. Interpretation of the expense-to-income ratio. The expense-to-income ratio provides insights into how efficiently a company manages its expenses relative to its revenue. Here's how to interpret the ratio. Lower ratio. A lower expense-to-income ratio indicates that a company is operating more efficiently because it spends a smaller portion of its income on operating expenses. This can be seen as a positive sign, as it suggests the company is controlling costs effectively. Higher ratio. A higher expense-to-income ratio implies that a larger portion of a company's income is being used to cover operating expenses. This may indicate that the company is less efficient in managing its costs. Key points. Benchmarking. The expense-to-income ratio can be used for benchmarking and comparing a company's efficiency with industry peers. Different industries may have varying expense structures, so it's important to consider industry norms when interpreting the ratio. Cost control. Companies often focus on lowering their expense-to-income ratio as a cost control measure. By reducing operating expenses while maintaining or growing income, a company can improve its profitability. Operational efficiency. A lower ratio suggests that a company is running its operations efficiently, which can be attractive to investors and lenders. It can also free up resources for investment in growth opportunities or debt reduction. Management's focus. Management teams often pay close attention to the expense-to-income ratio as a key performance indicator, KPI. They may set targets for reducing the ratio over time to improve financial performance. Risk assessment. A rising expense-to-income ratio may signal financial stress or inefficiency within a company. It may also indicate that the company is struggling to maintain profitability if expenses are growing faster than revenue. Investor and analyst interest. Investors and financial analysts consider the expense-to-income ratio when evaluating a company's financial health and efficiency. A consistently high ratio may raise concerns, while a declining ratio can be viewed positively. In summary, the expense-to-income ratio is an important financial metric that helps assess how efficiently a company manages its expenses relative to its income. It provides valuable insights into cost control, operational efficiency, and overall financial health. Thanks for watching, and don't forget to like, share, and subscribe.